Rate cut on a day we find out the economy is growing at nearly 4%. Just how bad does the Fed think the housing market thing is?
We welcome back our Fox panel, Gary B. Smith from Exemplar Capital, Nicole Ridgway, senior writer for SmartMoney.com, Mike Norman, founder of Economic Contrarian Update, and Peter Schiff, CEO of Euro Pacific Capital. We have security guards standing by Mike and
Keep
Peter.
it civil.
Just to haul them out. Nicole, let me let you get a crack at this. We had a really pretty decent GDP number here that showed that's gross domestic product, that indicates output of all goods and services in the U.S. So why is the Fed so scared?
Well, I think before this number came out, obviously there was this feeling that it was actually be a lot lower than what it came out to be. But, you know, the Fed is trying to do this balancing act between inflationary pressures and growth. And, you know, it's a lot of guessing in between. But the housing market is a legitimate concern, and they want to make sure that they can stoke the fires there.
It's inflation, Gary B., growth, and also concern about whether our banks are becoming decapitalized, whether they don't have enough cash in their reserves to service the people out there, the folks.
Exactly. Nicole brings up a good point. The Fed is in this ever increasingly hard balancing act between inflation and growth. You bring up a good point in that, Nicole started it. It started, obviously, with the housing market. But when those mortgages were repackaged, it flowed all the way through the financial market. So I'm not sure the Fed was just saying, hey, I'm going to bail out all the people that had, bad, low teaser rates. They're saying, wait a second. This rippled, good or bad, through the financial markets. You saw the whole commercial paper, liquidity tightened up. That's what we're after, because that looked like it could head us into a recession. Just
so people understand the concept of commercial paper.
Now, then we have to defer to Mike Norman, because I only know the sound bites, Liz.
Look, first of all, bank capital adequacy is still very, very high. Banks are still, sitting on excellent capital positions, so I don't think we really have to worry about that too much. The Fed, in its statement right here, it said, look, we had good growth in the third quarter, but there's a chance that the expansion will slow in the near term. One thing very interesting, which I haven't heard anyone talk about, is the fact that they say here the committee judges that after this action, the upside risks to inflation are roughly in balance with the downside risks to growth.
Translation?
Translation means they might sit for a while now because they're saying we see it in balance, upside risks to inflation, downside risks to growth. So what does that mean? If the market is pricing in, and we'll have to see over the next several weeks, the next month, if we're looking at an expectation of another cut in December, that might start to diminish. I don't know if that's necessarily a bad thing for the market, because it could be positive for something. I know something that Peter hates is the dollar, which might start to appreciate on this now.
Do we unleash the Peter?
We now unleash the Peter.
One thing that no one's pointed out today is even though the Fed irresponsibly cut interest rates again, the yield on the 10-year is up about 100 basis points on the day. And every single home building stock is getting hammered right now. If you pull up and look at the screen, they're all red, and they're all down 3, 4, 5%. And I think the way the dollar is falling, remember that all these mortgage-backed securities are bought by foreigners. They're the ones that have the savings. It's the Europeans, it's the Asians who have been lending money to Americans to buy homes, to refinance their mortgages. And when they finally realize that the dollar's a bottomless pit, they're not going to want to buy that paper. And interest rates are going a lot higher as a result of what the Fed is doing. They're not going down.
Peter, I just want to get back to one thing you said. Don't you think it would have been even more irresponsible for the Fed not to do anything and let us edge even closer, as I think they alluded to a recession?
No, we're going to go into a recession. We can't avoid that.
It's hell in a handbasket anyway, is what you're saying.
You guys stop laughing long enough for me to explain. The
you're
Fed,
funny.
all the damage that they've created over the past few years was because they wanted to avoid the recession we should have had in 2001 and 2002.
You mean the damage like the highest rate of home ownership? You mean the damage like adding $1 trillion of economic output since the credit crisis? You mean the damage?
Hold on, Peter. Let Mike finish.
Hundreds of billions of dollars in increased exports coming in. You mean the damage of corporate profits blowing through the roof? You mean the damage?
Okay. We get your point.
I could go on.
Mike,
You would have been a tough professor, Mike. Hold on, Peter, 1 second. We've got the home builders, and indeed you are correct. They are pulling back, but they've had a good run.
Right.
Nicole, when you look
Can I
at the
comment on what Norman just said?
Well, no, wait, because I want to hear what Nicole has to say about the overall picture for somebody who's holding the credit card with a couple of thousand on debt, and then who's got an arm that's about to reset.
Well, I think, the person with the credit card and the debt, obviously this interest rate cut, it helps people with looking for home equity lines of credit, and ultimately helps usually with credit card rates. So that's good for consumers who are dealing with debt. Mortgages, it's a little bit more of a trickle-down type thing. It doesn't have such an immediate impact on the consumer. I mean, it will eventually, but it's not as immediate, and it won't make people feel great about their reset rate
and Liz,
in the weeks ahead.
Yeah,
Liz,
Mike, I got to address what you just said. We achieved those record levels of home ownership by irresponsibly allowing people to borrow money that they can't afford to pay back. This is a disaster because so many people bought homes and borrowed money that they can't afford. We have not had economic growth. It's an illusion. The dollar isn't falling through the floor because things are so good. We don't have record trade deficits, record current account deficits, and a negative savings rate because we have a vibrant economy.
Just so
this
you
is
know,
a disaster, Mike,
Peter,
and
we get the point.
You can't figure it out.
Peter, we get the point, Mike.
In the past 4 quarters consecutively, Peter, the savings rate has gone up, and we have the highest household net worth of any country in the world.
No, we don't. You're dead wrong, Mike. You're dead wrong on that.
You are dead wrong. Look at the statistics, my friend. No. It's out there. Open your eyes. Take the blindfolds off. Stop.
Talking about taking the blindfolds off.
Okay.
Come on.
Gary?
How many things do I have
you
to
ran
get
out
right
of
before
steam.
you understand that?
Gary B, go ahead, quickly.
At the risk of getting between this NASCAR race between these two, I want to go back to a point Nicole made. In fact, she's right about the mortgage rates trickling down, but as someone who holds an adjustable rate mortgage, they've already actually dropped about 10%.
You're pointing to yourself, do you?
Yes, I have an adjustable rate mortgage that was tied to the LIBOR, which is the London Interbank Offered Rate. Don't worry about the technical stuff. It's just tied to a benchmark, if you will. Those have already started to come down. I looked up today the 30-year, the 15-year, the kind of the conventional mortgage. Those have already started to come down. I think almost definitely the Fed will lower in December